Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
We expect that in the third quarter, the Polish sovereign curve will steepen slightly. In our forecasts, we assume that 2-year, 5-year and 10-year bonds will finish the quarter around 0.20%, 0.80% and 1.45% respectively. Following a significant monetary policy easing since the start of the pandemic, the Monetary Policy Council is unlikely to further cut rates in Poland. Nevertheless, the central bank will continue its asset purchase program, which till date is the largest introduced within the Central Eastern Europe. To finance anti-crisis measures, the bond issuance increased in the last couple of months, and this trend is set to be continued in the second half of the year. The weight of the issuance is further increased by sale coming from state agencies. The shape of recovery from the crisis is likely to remain as main question mark, however, it is expected to be rather gradual than sharp. Stimulus provided by governments and central banks resulted in cautious optimism among market participants and is limiting further widening of asset swap spreads. Since the beginning of the coronavirus pandemic, the Polish Monetary Policy Council slashed the reference rate by 140 basis points to 0.10%. Although the monetary conditions are likely to remain loose, further rate cuts are unlikely as even doves are hesitant to introduce negative rates. Inflation remains so far above the 2.5% target. However, the MPC is convinced that it should fall further, getting closer to the target by the year-end, which should support already introduced measures. The National Bank of Poland bought over 100 billion worth of bonds since introduction of its asset purchase program. This translates to roughly 4% of GDP and is much higher than the programs announced by other central banks in Central Eastern Europe. The dovish stance in monetary policy, which however does not see negative rates, should anchor short end of the yield curve around the reference rate. Bond issuance coming from the Polish Ministry of Finance is elevated since the start of the pandemic, as debt authorities issue securities on regular bond tenders, as well as use private placement procedures and reinstated treasury bills auctions. We expect that debt supply in the second half of the year should put a pressure on the long end of the yield curve. The government has already signaled that budget revision is likely during summer. This should result in an increase in budget deficit and in borrowing needs. Further pressure on long-term bonds stems from the issuance coming from state agencies. The state-guaranteed bonds are offered to the natural pool of government bond investors. Proceeds from state agencies' sales, which amount to 117 billion zloty, are also used to finance anti-crisis measures. Polish GDP is widely expected to fall by about 4% this year, which should be one of the mildest slowdowns in the European Union. Nevertheless, the scale of global downturn is still hard to assess as incoming data are showing a mixed picture. Additionally, the fears of second wave of coronavirus infections and the risk of reintroduction of lockdowns may weigh on sentiment. So far, the global moods were boosted by the stimulus delivered by fiscal and monetary authorities globally. We expect that this cautious optimism is unlikely to transform once again into widespread risk-off, which should also allow Polish asset swap spreads to remain stable and around 50 basis points in 10-year tenor.